Well, good afternoon. My name is Jeffrey Smith. I'm the Chief Instructor at DTI, and I want to kind of give you a brief overview of how I kind of look at the markets, things of that sort, so you kind of get an understanding of what we're looking at when we kind of start getting into everything here. And then we'll kind of get into the little 5-step process that I'd like to kind of go through just a little bit and somewhat. Just real quickly, how many people in here have not traded stock before? Anyone? Don't be shy. There's a lot of things I haven't traded, so. Anybody? Okay. What about options? Anybody not trade options before? Whether it be equity options or options on futures or anything like that? Got several on that one. What about futures? Anybody not trade futures before? That one says only futures, never. Okay. Well, those are basically your 3 main groups, I'll put it that way. If you want to kind of throw Forex in there, there'd be 4. Currencies, Forex, things of that sort. They kind of move a little differently than the other markets, just depending on whose country has the best or worst economic news or whatever is out there. But when we start looking at kind of trading itself, and I'm going to throw a little disclaimer up here very quickly. Sometimes I make typos, and of course, the trades we get into, we can't win them all. Past performance not necessarily indicative of future results, which sometimes it's a good thing because you don't want to lose every time, right? And sometimes it's kind of a bad thing. But when we start looking at trading, I think everybody, regardless of what you do, I think everyone likes to win. Nobody likes to lose, and that's a real big thing when it comes to trading. How much can I win? And can I, if I do lose I lose just very, very little? And the big thing that we get into on that is kind of risk and reward. And I think people look at risk and reward pretty simplistic. They never put the odds of a trade in there. What are the odds of that trade working? I mean, I can just go out and short the market right now and say, well, I'm going to only risk a point and see if it just dumps off. Well, what are the odds of me making money doing that with the market just going up and up and up today? So the odds greatly decrease with me doing that. And that's the one thing that we have to start trying to do, is trying to figure out how to eliminate as much risk as possible and try to maximize our reward as much as possible. And I think everybody kind of feels that way when we start looking at markets. It doesn't matter what I trade. I just want to see if I can't make money and try to minimize what I lose. And I think when we start trying to figure out what's the best way of doing that, the one thing you have to kind of look at is well, do I like to buy breakouts? Do I like to buy on value? Am I an investor based off fundamental analysis? Am I an investor based off of technical analysis? Or do you use a combination of the two? And that's the one thing that when we look at DTI, we actually use kind of a combination of the two. We look at both the technical side of things, but we also like to look at some of the fundamentals of things as well. And if we can kind of put the two of them together, we can probably get a better idea of what's going on, because even though a stock might be going up, it might not last that long just because fundamentally it's not that great of a stock. And that's one thing that we really have to kind of pay attention to, is when we're buying something, how long can it hold on to that trend? And it might hold on to it for a short-term basis. It might hold on to it for an intermediate-term basis, or maybe it finally turns things around a little bit and kind of goes up. I mean, if you look at like Amazon, you look at it at it fundamentally, its PE is above 200, which nobody would even touch with a 1,000-foot pole, right? But yet it keeps trying to go up and up and up, just because of the way the architecture of the company is. It's a whole totally different way of looking at a company. They bring everybody to their website and they sell a bunch of stuff, and yet there are quarters where it loses money, and they've always struggled about making money or losing money, but their stock is up here at $330 a share. So there are some that kind of go against the overall grain of things that fundamentally doesn't work. So technically you have to kind of look at them and say, well, if they can, as long as they stay above a specific price, then they ought to continue to move higher and start going along those lines. So that's one thing that we start looking at here at DTI, but we also do things based off of a 24-hour basis. It's not just when the New York Stock Exchange opens and the New York Stock Exchange closes. we actually look at the market on a 24-hour basis because, well, if you think about our stocks don't just trade here in the United States. If you had an account over in London, you could trade IBM and Disney and Apple and things of that sort. In fact, if you watch CNBC or Bloomberg in the morning, you can watch our stocks trading in Europe, which is really kind of interesting because if you look at our indexes, the S&P 500 index and the Dow 30 index and the NASDAQ 100 index, or even the NASDAQ composite if you'd rather watch that, you'll notice that it's not moving around at 4 o'clock in the morning or even at 6 o'clock at night. And the reason for that is because, well, they've turned the index off. When the exchange closes, they turn the index off. Yet the stocks in that index, if they're moving around, then the index should be moving. So we try to watch things that kind of track along those lines to give us an indication of what our stocks are doing around the world. And so when we start looking at what we do here at DTI, we are an educational facility that kind of looks at this 24-hour market. It's a global marketplace nowadays. And when we start looking at this global marketplace, it matters what happens in the Asia. How could I figure out how to do something along those lines? And that's one thing that we always try to look at throughout that 24-hour day. We have a piece of software which we'll be kind of gandering at a little bit here just because I look at analyzing some things. That's what I use. But it's our roadmap software. And that really tracks markets 24 hours a day, as long as I can anyway. Some markets aren't open 24 hours a day, but some of them are. Some of them are open at specific times of day. They'll open at one time, close, and something else is going along. Of course, we also have support not only for the software, but for our traders. We try to help our students out the best we can, regardless if they've haven't talked to them in 3, 4, or 5 years. We still have people who come back and say, hey, we're more than happy to help them out, just because we always want people to do better in their trading. And that's really kind of the the basis of our education is we don't give up on you until you give up on you. I've been through some hard knocks. Tom definitely has. And so when we start looking at trading in the markets, we always want to make sure that we can always better ourselves as opposed to just kind of giving up and going from there. Our method is really made up of 3 main elements. It's made up of time of day, our 24-hour market, as I was just talking about. Key numbers, which are support and resistance in the market, which I think most people use. They use some sort of buy levels and sell levels and things of this sort. And of course, market indicators. Of course, we want everything supporting what our decision is, right? So when we start looking at our 24-hour clock, just to break it down, we make it into 4 separate time segments. This is day to day to day. And the Asian time segment is our first time segment. It's actually the open. If you go across the international date line, the Asian market, the Australian markets, New Zealand markets, actually New Zealand's actually the first market to open around the world. That's where everything begins our 24-hour day. So here, now this is all in Central Time. So if you're on the East Coast, you have to kind of add an hour to this. West Coast, subtract a couple hours from it, whichever. But the Asian markets, we'll look at them between 5 p.m. and 3:30 a.m. So that's our longest time segment. What this does, it incorporates all the Asian markets opens and closes, and it gets us actually into the European market opens. The thing about Europe and why Europe actually opens up at 2 a.m. Central Time. You'll notice we'll start the European time segment though at 3:30 in the morning, and that's because they have a lot of economic news that comes out between 3 and 4 o'clock in the morning. Here in the United States, we have tons of economic news at 7:30 a.m. Central Time, or 8:30 Eastern. We get our CPIs and PPIs and GDPs and retail sales and stuff like that pre-market. They always let their market trade for about an hour, hour and a half, and then they throw out all their news. So they're a little different. And of course, news is market food, right? Good news, market goes up. Bad news, market goes down. So we want to see how their economic news affects their markets. So after their economic news gets out of the way, we want to see what their trend is. Are they trying to trend higher? Are they trying to trend lower? And of course, we get into the U.S. market here, and we will actually try to see how we have valued or devalued things based off what the world's done. Do we agree with what the world's done? So we take things higher and higher and higher. The overnight markets have rallied, or do we disagree because our news? Well, ours is bad when all yours is good, so we sell off during our day after they have rallied the market throughout the night. So, and that's really the reason why we've broken up the market in these 4 time segments, is to specifically say wherever the sun is who controls the market at that time. Once we get past our morning market here, we just have the Americas left, and we get into the afternoon time segment where we have a lot of closes in, a lot of the various different markets that are out there. And we'll get past all those closes. We'll round out our day. The futures don't close out until 4:15, which is about an hour and 15 minutes after the equity markets have closed. Then they take a 45-minute break and they start all over again. So it can be a very, very, very busy day. We have to kind of hone out where we want to trade and what we want to look at. And of course, this is a real quick picture of our software. And in fact, let's just do this. Go over here. See if I can't share my desk. Oh, nope. Cancel. That one. Bling, ding. There we go. That's a live. If it's too big, you can hit a little thing at the very, very top of your little screen. It has little arrows pointing toward the center, and it'll kind of make it smaller and fit it on your screen. Otherwise, there's another one that points out, and you can make it bigger. You can kind of fit it around and things like that. But this is our roadmap software. And just very, very, very quickly, so you understand what we're looking at, I think most people get this part. This down over here is just a quote page. This here is what we call a compass chart. It has these buy zones and sell zones in it. This is what we call an ETR page. And notice it says ETR. ETR stands for electronic tape reader. And what this page is doing is, chicken scratch there. It's actually looking at the market every half hour, like a 30-minute bar. And this is the open of the most current 30-minute bar on this line. And this line is red or green based off how we're trading off of that 30-minute bar. So if I see this line all green, that means this is all red. It's heading lower. And if it's yellow, there's no change from its current price from where it opened. So you'll notice on the charts we have red bars, down bars. We have green bars, which are up bars. We have these blue bars, and those blue bars are the open of each of those individual time segments we were just looking at. Just to kind of show you something here, let me go back over to, let me get my chicken scratch. Let's go over to here very, very quickly. Back a slide. You'll notice on this slide we have 5 to 3:30 a.m. We have the European from 3:30 to 8:30. We have the from 8:30 to 12:30. So there's 4 different time segments. And you'll notice, let's go back over here very quickly. I'm kind of flip-flopping around a little bit, but just bear with me for just a moment. We kind of spread this out somewhat. This right here is that 5 o'clock open p.m. Central Time. This is the Asian markets up until here. And notice it kind of did up just a little bit. We get to Europe. That's that time segment 2 open, another little blue bar. And it kind of trended up a little bit, kind of like Asia did. So from here to here, we've kind of sloped up a little bit. This right here is our 8:30 open. And notice we jumped up off of it. And now we're waiting for that last time segment, which happens here in about an hour and a half. We'll get another blue bar to kind of finish out our 24-hour day. But each of these individual time segments are their own market, if you will. Just because we went up in Asia doesn't mean we'll be up in Europe. Just because we were down in Europe doesn't mean we'll be down in our market here. We all have our own economic newses. We have our own people, flapping their gums and things of this sort. So we always want to keep those time segments separate, even though it's one day. Each individual time segment is literally its own little time in the marketplace. So go back forward here. Let's start going through our little 5-step process now that we kind of got all of that stuff out of the way. The big thing when we start looking at trying to place a trade, hopefully making money, right, is we want to pick the right market. And of course, we want to analyze the trade. What are the odds of it working? Of course, we have to figure out if we're going to go long or short. We need to figure out our risk versus reward. Then we've got to figure out how to execute the thing. So when we start looking at picking the right market. The first thing I look at, what time of year is it? I mean, a lot of people have heard when in May go away. So equities historically, over all time, probably trade best between like October and May. You look at commodities. Now, I mean commodities like grains, corn, soybeans, wheat. You look at crude oil, natural gas, things of this sort. Are probably best traded between April and October, just because of harvests and things of this sort. Now there are some commodities that will move during the winter time. Think about natural gas. Natural gas is used a lot during winter, right? So natural gas, if we have a real hard winter like we had up in the Northeast, had this big storm come in, natural gas will jump up in price. And of course, when we start looking at the time of month, because if you look at our economic news here in the United States, we have one real big piece of news at the beginning of the month. We have the non-farm payroll numbers, right? But go look at next week, see how much economic news there is. There's hardly any economic news next week because they pile most of our economic news toward the end of the month. But yet, if you go look at Australian economic news, you'll notice all of their economic news comes in the first week or two. So depending on the country that you're in, you might have one country with a lot of economic news at the front of the month. You might have another one that throws it toward the end of the month. And so myself is more inclined in the evening time, because Australia is open in our evening time, is to trade the Australian dollar in the evening during the Asian markets, as opposed to trying to trade the S&P Dow or the NASDAQ or something along those lines. So that's the one thing that I look at because of a specific time of month, or I might be looking at something else because of the time of year. And of course, when you look at time of day, it all depends on what time of day you're talking about. We're in the Asian markets, European markets, our morning markets, our afternoon markets, because our S&P Dow and NASDAQ don't move near as much during the Asian and European time segments as they do during our time segments. But if you're looking at Europe, you might be trading the DAX or the Euro stocks during their time segments, since those are their indexes. So that's the one thing that we have to look at, is that specific time of day to figure out what's open and trading and what would have more influence. So we also have to look at news. News is a market mover, and what news is coming out that day. Is it important to the market or is it not? There are some newses that are important to the market. There are some newses that the market just kind of has a tendency to blow off. So we have to kind of look at each news item throughout the day. I actually go to investing.com. I don't know if you've ever been there or not. It's kind of a cool little website. They have a nice little economic calendar that gives you all the news for just about every country in the world. You can actually click on a little filter and filter out what you don't want to see. But you can look at those news items that are coming out throughout a 24-hour day. And of course, if you're not going to be up there during that time, it really doesn't matter, but just realize that that's probably what's going to move the market during that time of day. You had an interest rate decision last night in Australia. They left their rates at 2.5%. So there it is. Australian dollar probably moved last night. And in fact, we just look at that very quickly. There we go. Notice the Australian dollar's up pretty good. Find the bar that their news came out on last night. Economic news. And you'll notice here on this bar, you went from, let's see, we got something going on here. I got the chart, but the prices didn't come in just exactly right. But we had a nice little move. We went from somewhere around the 94, I forget where it was. It was 93. Actually, it was 93, 97 or something like that, to about 94, 97, something along those lines. So I had a nice little decent move last night. And looks like we'll get this back over to, there we go. But anyway, when we start looking at these economic news, we can kind of figure out where they are and can we make money off of it. And that's basically what we're kind of looking at when we look at those news times. When we look at analyzing the trade, one thing that I like to do is kind of pull up kind of a broader picture of something. And if we look at kind of a weekly trend, just a weekly chart here, This is, I don't know, soybeans. Notice we had this nice uptrend, and all of a sudden we have this down move. So we've taken out no big support here, which is actually holding some pretty good resistance back over in here. So if we start looking at, kind of a daily trend, you can kind of see where we were holding things up in here, and all of a sudden, we need to kind of get over here, don't we? We have this little support back over in here. So when we start looking at a lot of these trends that we have, maybe the reverse, beginning to reverse off the daily. And the reason for this, again, is economic news. We actually had the acreage report come out yesterday, and we had an 11% increase in acreage in soybeans. Therefore, we have more soybeans, supply demand. There's a lot more supply now, and so the price dropped. There it is. And that's about literally a 70-point drop, which is about a $3,500 move per contract. Pretty substantial. And of course, you take that down to a 30-minute, and you can see yesterday's drop in a half an hour, and then it kind of has been tapering off ever since. So I always try to look at what that overall trend is, and that way I can start figuring out, hey, is buying this thing a real good idea? And the one thing I don't like to get into is trying to bottom feed. The reason why I don't like to bottom feed is because it might drop some more. It's like catching a falling knife. It's kind of hard to do. So I would probably look to try to short this market somewhere, and kind of go from there. And if you kind of look at today, that blue bar, let's kind of keep this like this. Notice what they did here at the open. This is 8:30 this morning, Central Time again, up here right around 46, and they dropped down to 32. Now they've bounced back up, but notice they can't get back above that open. So they're going to end up negative on this day as well. And they're going to stay along with their overall trend. So if I was looking at trading soybeans being the time of year, or even trading wheat or corn or something along those lines, I'd be looking for more of a shorting opportunity than a buying opportunity. And now, does that mean I can't go long today? No, you can try to go long today, but it's easier, in my opinion, to stay along with the overall trend, which is why I look at that. And does the weekly trend, daily trend coincide? So we answer that question. Do we go long? Do we go short? Or do we stay out? And in today's case, I don't know, I might be arguing to kind of stay out a little bit. They can't seem to go down. They're kind of rallying up here a little bit. So at this point in time, it'd be hard to do. But this morning, I actually shorted soybeans on this bar and picked up a little money. But the thing is, I was going along with the overall trend. They've kind of bounced back up here. They got me out of the market. And now I'm trying to figure out if they want to go down some more, if they want to just kind of hang out a little bit after the big move that they had yesterday. So, and you'll notice we're staying inside of this range here. Here's the high there. Here's the low of this blue bar here. See those two things right there? We're staying inside of that little range. So I keep forgetting to go back from point to point here. But my point is today might be a good stay out day range. So between 8:30 and 9 o'clock this morning, or 9:30 and 10 o'clock Eastern, they opened up, they traded, but they haven't ever taken out that range. Unlike the indexes, you notice here's the range on the S&P. They took out the range. Here's the range on the NASDAQ. They took out the range. Here's the range on the Dow. They've taken out the range. So all broken out to the upside in the indexes, but this grain can't seem to go somewhere. So it might be one of those days that you just kind of stay out. But overall trend, we've broken below support on a longer term trend. Even on a daily trend, we've kind of broken down. So now the question is, do we continue to move lower or not? Finally, we start looking at risk and reward. And this is the last thing we're going to be looking at. But we start looking at risk and reward. So now I've got to sit here and think, well, if I do try to short this market, what do I have to risk? Even if you look at here, let's go over here to the S&P here. You know, we're trading up here at, you know, this 1966 area. So the question is, if I get long, since we've been moving up, and we just made a new all-time high in the S&P up here at 67.5. So the question is if I get long here, what do I have to risk? Well, initially, on a very short-term basis, right here below that 65 range. But they've also been down to 64.5. So is it 65 or 64? Well, we know if we take this out, they're probably going to move on down, back down in here to around 62 or so, right? So that's what we're having to look at. Again, I got to flip back and forth here a little bit. But we have to start looking at, you know, what the risk is to be in this thing. I wouldn't have a problem with trying to buy it and no risk in a point. I mean, this right here is the S&P 500 futures contract. It's worth $50 a point. So if I can get into it and risk $50, fine. But if I have to get into it and have to risk, you know, $300, that might be a little different. What if I have to risk, you know, $800? Well, now we're starting to increase our risk. So you're wanting to reduce as much risk as possible, but maximize, you know, your gain here. Question is right now a good time to trade this? Well, Europe just closed out an hour ago. Right now it's 12:30 Eastern time, so a lot of people are probably eating lunch. So a lot of the volume's probably pulled out of the market right now. So it would be a real great time to jump out here and try to get long, you know, in the index futures or something like that at this point in time. So we might opt to stay out here, but we might start looking at, you know, here in about an hour when things start maybe picking back up in volume again and seeing if we can start, trying to find a trade to the long side. Or do they reverse the market today? Do they take out that, you know, 64, 63 and start bringing things back down all the way back down to 57? I mean, heck, they could close this market back down here at 59, drop it about 6 or 7 points, and still have an up day. So, you know, they might try to correct it this afternoon. They might not. They might take out that 67.50 high and, you know, try to go test, you know, 1970 or maybe 1975, something like that. I don't know, somewhere around those areas. So that's the one thing we always have to start looking at is how much risk is involved. If you're a longer term trader, you know, you have to start looking at, let's just look at the, I don't know, here's an hourly chart. You know, you might be able to risk down to that 63 area and be okay. What if you want to buy this thing and hold on to it for, you know, a week or two? Well, are you willing to risk all the way down here to, you know, 1938? That's a 30-point stop. So it all depends on the type of trade you're trying to get into and how long you want to keep it to start trying to reduce risk. And maybe we don't even use this. Maybe we go over and trade the SPY, you know, the spider. Maybe we go and, you know, do options. Maybe that'd be the easiest way of doing it. And so this is where we have to start trying to figure out, you know, where we're going to have to start executing. The problem that we run into as traders, though, I'm going to run back over here very quickly, is think about this very, very, very quickly. I mean, have you ever been in a trade where you had the direction right, which is what we've been trying to find here, right? Had a good idea where, you know, you're going to get into the market and have a good idea of probably where it's going to go. You know, if we get long here, you know, the S&P might go up to, you know, 1970 or 1975. So you get into the market goes against you, it stops you out. And then by the end of the day, it's exactly where you thought it would go to. Has anybody ever had that problem? Ever run into that? Come on. I've had it happen to me a million times. There's nothing more irritating. Yes, a lot. Thank you. There is nothing more irritating, more frustrating in the market than when you sit there and go, man, I think this thing's going up. So you get long, you put a stop in, and it pays you a little bit, and it backs up, and you're like, well, I'm okay with my stop. And it comes down and it stops you out, and like, dang, I thought this thing was going higher. And not 2 hours later, it's exactly where you thought it was going to go to. Nothing is more frustrating than seeing that. And so I've always tried to figure out, is there a cool way to try to get around that? And so all of a sudden, somebody told me about Nadex. And I thought, Nadex, binary options. And when I heard the word binary options, I was trying to run as fast as I could to the door. And to me, I mean, a binary option is basically an intraday short-term option. And not only that, but it's a right or a wrong thing. Are you right or are you wrong? And to me, I didn't like that. I mean, right or wrong. Well, to me, in trading, I can be a little bit right, finance the wrong, and if I get stopped out, it didn't hurt me any. So, and that's the one thing that I was looking at. But I went back and asked myself this question: have I ever been in a trade, had the direction right, had a good idea where it was going to go to, and they stopped me out, and well, it went to that same spot that I thought it was going to anyway. So I got to thinking, maybe this has some merit to it. So anyway, let me come over here. I think I've already logged into that. There we go. So anyway, here's Nadex. It's actually a trading platform. You can go to nadex.com and check this thing out. And here's the deal on Nadex. And I don't know what I have up here. It looks like soybeans. That's what we were looking at. Anyway, what this is doing is you have strike prices, and these are your strikes through here. And notice the time here says 2:15 p.m. Now this is all in Eastern time, okay? So that'd be 1:15 Central. So basically it's saying, and you'll notice the sign here, it says November soybeans greater than 1153. November soybeans greater than 1144. All right. And we're currently trading over here right around 1142 and a quarter. All right. So if you find something around that 1142 area, which is right here around this 1141, it'll be somewhere around 50, 60 cents. And you'll notice, or 50 or $60, sorry. And you'll notice that's right around 50 or $60. And what they're doing here is saying, okay, since we're trading basically at this price, you have a 50-50 chance whether you're going to be right or not. That's all it's telling you. And since we're trading above that price, you have a greater than 50% chance of being right by 2:15 close. So here's what you have to kind of look at very, very, very quickly. Going back to our little question, have you ever been in a trade where you thought you knew where the market was going to go, and all of a sudden you sit there and go, well, I got stopped out and it went there anyway? And that's where this is kind of a cool little deal, because if I think, for whatever reason, that soybeans to get above 37, which is basically its high today, and I'll go back over here very quickly. Where is it? There it is. Notice this high right here is right here around this 1148 area, okay? So if I think soybeans on this little trend that we have little up here, that we're going to close up here somewhere, then what I can do is say, well, I'm willing to bet that I can buy this. We would be buying this for somewhere between $50 and $22, 15 to 22 bucks. So I can risk buy something. The only thing you can lose is what you pay for it, right? So if I buy this for, let's just make it, right, and say we buy it for 20 bucks. If I'm right on the binary option, it will settle at 100, okay? If I'm wrong, it will settle at 0. So if it settles above 1147, all right? If it settles above 1147, then, and I can actually here, let me just kind of show you this very quickly. So that's a sell, here's a buy. So if we buy this thing at 20, one contract, makes it simple math. Notice down here on your ticket, your max loss is 20 bucks. My max gain is 80. So think about your risk reward ratio here, right? 4 to 1. I can make 80 or lose 20. But talk about limited risk if you're going to be right. If I think that soybeans is going to go above 1147 and finish there today in about 2 or 3 hours, then I can risk 20 bucks here, and if I'm right. If I'm wrong, I lose the 20. If I'm right, they're going to pay me 80. All right. Now, let's go over here and look a little bit of risk here. I could buy soybeans here at 42, see if it'll go up to 47 or 48 and get out, which I'd make 5 points. Let's just use a one lot again. All right. Or if it drops down, I'm going to have down here below 35. So I've got to risk 7 points. So look at your risk reward. Risking 7 to make 5. On the Nadex, I'm risking 1 to make 4. Real big difference in my risk reward, right? So instead of me trying to jump over here into soybeans and having to risk minimum $350 a contract, I can come over here to Nadex, and where'd my Nadex go? There it is. I can come over here to Nadex and say, you know, I still think it's going there, but I'd much rather risk $20 than $350. And I can make 80 if I'm right. So I can change my risk reward around very, very, very quickly on the exact same trade. I still think it's going above 47. And if it finishes at 47 and a quarter, that's actually 1147. 1147 and a quarter or higher, because it has to be greater than 1147. If it's 1147 quarter or higher at the close, I get the 80. If not, then I give them $20. So that's what you look for. And like I said, when I'm looking at risk reward, a lot of times I'll sit there and go, I want to get long here, but I got to risk a lot of money to do it. And immediately I'll flip over to Nadex. Now, in Nadex, this is a binary option. There are also what they call bull spreads. I'm going to go to that very, very quickly. Here's your commodity bull spreads. Let's just look at this again. Here's your dailies. And what this is showing you here is this is a spread range in here. All right. And now we have to sit here and look at it and go, okay, do we think inside of here, if we buy this spread, this 1130 to 1170 spread, if we get long here, we'll be paying somewhere around this 1144. Let's just kind of pop this into a ticket here very quickly. We're going to buy one here. If we're right, we can make $256. Now that's if it gets back above 1170 today. So my question is, what are the odds of it getting back above 1170 today? Probably pretty slim, right? So, but if we think it's going to 1150 or 1160, alrighty. So I can probably pick up, since we're here at 1144, I can still pick up 5 to 15 points. So, but we're not going to put this 26 points or 25 points or whatever it is. And it's $10 for every point it moves. So but I'm having to risk 144 if I'm totally wrong, or I can make 256 if I'm totally right. All right. So you can do the spread. Now the one thing is, what if you think that soybeans is going to go down? Well, you can't go long the spread. You can't go long the binary. So you're going to have to sell it. So again, we can look at that, and I'll go back over just to the binary very, very quickly. Go back over to here. I can look at it and go, I really don't think that the soybeans is going to close of this 1142, 1143 area. And in fact, let's go back over to here, look at our little, let's just say that we think that soybeans is going to come back and settle basically below 1140 to 1139, right back into this little range that it was kind of messing around with in here. All right. So I can come back over here and say, well, it's in an uptrend. I don't know if it's going to make it there or not, but I don't think it's going to get back above here. And we can kind of start seeing if we can't sell something to kind of give us an indication that maybe we can make a little money off. So again, we look at this, we got the 1141s, we got the 1140s. So the question is can I sell this 1144 here for somewhere around 50 bucks, right? And if it finishes below 1144, which is what we're on here, here's 1144 right here. If it finishes back below 1144, I get 50. If it settles above 1144, I lose 50. So it's a 1-to-1 risk reward. So if I come over here and sell this, and let's just put it at 50, again, a one lot, it'll tell you, well, you're risking 50 to make 50. So I can risk 50 bucks here as opposed to coming around shorting soybeans at 44, putting my stop above 47 or 48. I mean, I could risk 50 bucks as opposed to 150 bucks. Either way. So I can use Nadex to reduce the amount of risk that I have in a trade very, very, very quickly. And it's one of those things where, you know, I'd like to be in that market. I think I'm going to be right. But if they stop me out, why lose money on it? And if I do lose money, I'd much rather lose the 20 bucks or the 50 bucks as opposed to having to lose the 350 or the 150 or whatever it is a contract. So this is just one way of reducing things. You can also use Nadex for hedging. I don't know if you ever hedging anything or anything like that. But if you look at something like gold, a lot of people trade gold. And let's just go to daily on gold. If you're short gold thinking, well, I don't think gold's going up, I think gold's going down. And it might be best to use the bull spreads on old gold here for that case. Let's just use it. Here's a daily. But think about this very quickly. If gold right now is right around 1328, we have here's a 1325 to 1375 spread. Let's say we sell one gold contract. All right, we can come over to Nadex here and buy 10, because it's 10 bucks a tick, so we got to have 100 bucks a tick or a point. We could buy 10 Nadex spreads in between the two accounts, because you can't sell a gold contract here. Between the two accounts, you don't have to do anything until gold gets back above 1375 in theory, because as gold goes up, your binaries pay you. As gold goes down, this pays you. So you're basically perfectly hedged between those two commodities, actually two accounts. So you can actually use this as a hedging tool. And even if it does go up a little bit, tomorrow you can come in here and buy another spread, buy another 10 lot as it continues to go up and up and up and up and up. So you can actually use this as a lowest way, if you will, to kind of hedge positions that you have in other accounts. But I like using it specifically to say, well, I think it's going to go here, but why risk so much money in the future side of things to see if I'm going to be right? And if I think I'm going to be right today, this will pay me. If I'm not right today, well, I lose a little bit, not a lot. If that makes any sense. So when we start looking at trying to figure out, not only where's my trend, where's, do I need to be long, short, or out, but my biggest thing is trading is how much do I have to risk to be right? And sometimes when I'm looking at futures or commodities, or if I'm looking at stock, you look at a stock like Netflix. You look at if you were short Netflix yesterday, right? Because Netflix can't get above 450. I think Netflix is going down. You woke up this morning in some pretty serious pain. It was up about 15 bucks just because Goldman Sachs came out tonight and said, hey, we think Netflix is a buy. So all of a sudden it jumps up, right? So, and it's the same thing. If you don't want to have to take the risk for something, why not come over here to Nadex and say, hey, I don't have to risk a whole lot to do that. Now, one thing that, and I'll be the first one to tell you here, you look at all the commodities that they have. They have crude, natural gas, corn, gold, soybeans, silver, copper. You can't do live cattle. You can't do lean hogs. You can't do wheat. There's some things you just cannot do. Coffee, cocoa, cotton. So you're kind of limited on what you have. Now, you have to kind of look at it from their side. They're going to have some demand here to trade these things. They're not going to, add everything. But my guess over time, they'll add some more things to it. Not only that, but when the markets are heading down, I mean, we do get into bear markets sometimes. We get into some very, very, very bear markets. And I mean, you go back to 2008, 2009, everything was just heading down. It'll be easier to have bear spreads, not bull spreads. So you are kind of limited on direction here. You'll make more off the bull side than you will the bear side. A lot of times, you can sell the spread, you can sell the the bull binary, but it is literally is it going to be above here or not? And here's another thing that's kind of limiting. You'll have a day like you did in soybeans yesterday, and kind of go back over here. You'll see the bar. There you go. You probably had a your binary range was in here somewhere. You could buy these, you could sell these as much as possible. But once this little time was over here, I mean, there wasn't a binary you could buy or sell. But if you were already in that binary in here, then it paid you 100% if you sold. But that's the thing. That's what one thing I wish that that would change is it'd be nice to have some bull or not say bull, some put binaries or bear binaries or something like that, just because not all markets go up all the time. Some markets do go down. It'd be easier to try to guess if something's going lower than higher, and they say, well, sell it, fine, but if I get out of a range, I can't do that anymore. And that's where your put spreads would probably be better off. But it is a great way to reduce the amount of risk that I have in a trade. So even though you might find that, hey, today, buying the stock or buying a call option or doing a a put spread or whatever it is in the equity side of things might be the best way of going about it. This is just another way to kind of help you reduce risk and maybe increase gain when you're trying to figure out, hey, I think this market's going higher, but I got to risk too much to do it. Can I come into here and risk a little bit, 20 bucks, to see if I can make 80 out of it. And if you want to do, of course, 2 or 3 or 4 contracts or 10 contracts, whatever, it doesn't really matter. Platform to do that. You can kind of look through here. Here's your indices. If you want to look at indices, and they've changed the names to protect the innocent, I guess is the best way of putting it. You've got the US Tech 100. That's the NASDAQ 100. FTSE Financial Times Stock Exchange 100. Wall Street 30. That's the Dow 30. US 500, S&P 500, the German 30, that's the DAX, the US Small Cap 2000, that's the Russell 2000. So since those names are already, trademarked, coined, whatever it is, they got to change the names, so they have. So if you're trying to figure out exactly what these things are, they're the exact same thing, and you'll notice the prices are the exact same thing as well. Another thing is they have events. Here's your non-farm payroll events, and here you go. And basically all they're doing here is giving you a way to trade that event. Do you think non-farm payrolls are going to be above 180,000? If so, you can buy this binary. Right now it's at 70 to 80, okay? So your max profit is going to be 20 to 30 bucks if you buy that. If you don't think it's going to do that, you could sell that binary and pick up the 70 to $80. Your max loss would be that 20 to 30 bucks. So, but you can actually trade events in here. You'll see the World Cup in here, so I guess it's not that kind of an event. It's more of the news events. So I guess that'd be more like betting if you're on the World Cup side of things, right? But here's jobless claims. Jobless claims is in here every week. And you can kind of check that out if you have a big news item, GDP, retail sales, stuff like that. They're just looking at big economic news as far as events are concerned to see, if you think something's going to be higher or lower, you can actually trade that. So, but anyway, that's a little bit about old Nadex there. So, I'll go back over here to ding. And finally, if you have any questions, feel free to call us here, 800-745-7444. And if you want to kind of kick the tires a little bit here at DTI, we'll put a link in to register to come to our Thursday night or Thursday morning open house for our trade room if you want to come see it. You can call us here at 800-745-7444, and you can go from there. So let me pop this thing in here very quickly. Give me 1 second. There it is. Just click that, and you can come check us out. Otherwise, hopefully you've learned a little something. And if there's anything that I can answer, let me know. I'm open for questions now, I guess. As I kind of
Jeff, this is Raleigh. Jeff, I just want to thank you so much for your time today. And there were a few questions that popped up during your presentation that I just took note of that I'd like to share with you. And early on in the presentation, when we were talking about Nadex, there was a question that came up, and it was pretty direct. It was like, hey, is Nadex just gambling? And what are your thoughts on that, Jeff?
I'll start off by saying my initial thought of it was just the exact same thing as that. I actually thought it was gambling. No, I don't think it's gambling. No, after kind of looking at the I guess the root of why they created it, it's really kind of a nice way, in my opinion, to look at a market and say, I'm not willing to risk a whole lot to see if this market can go from point A to point B. And you might look at it as gambling and here's, I think, one thing that's very hard to kind of break out of a barrier. A lot of people will look at a stock or maybe even an index. I bet you the S&P is up today. Well, that to me is not a gamble. It's an odds trade. I think the S&P is going to be up today too. Well, now you have to go pick a price, and that might be the more difficult thing, is to say, I think this will be above said price. But you don't have to do it first thing in the morning. You can sit there and wait and kind of see how things go throughout the day, and then say, my analysis is right. We've been moving up throughout most of the day. Why not see if I can't make a little money off of my analysis? And that's really what you're doing with Nadex. You're trading your analysis. You're trading your analysis if I think this thing's going to be higher today, or you think this thing's going to be lower today. So you go out and buy the binary to say, hey, I think we're going to be up today, or we're going to be down today. The thing is you don't have to put a whole lot of money on the line to do that. You can actually put a little bit of money on the line to say, hey, this is what I want to do, and this is what I think. And if it happens, it happens. If it doesn't, well, we go back and reanalyze things for later on.
Sure, and I think that's a great answer. That's sort of the way I look at it as well, Jeff, is that you're making a very determined decision as to what you want to do in the market using some of the other techniques that you have. And to that point, one of the things that I picked up here, Jeff, is that, I mean, you are a professional trader in the markets, and I think from your perspective, what you were really driving home here is, how much do you have to risk to be right is one of the thought factors that you go through. So to that point, if you're looking at a market in futures, and let's say hypothetically it is soybeans, and you're very certain of that trade, do you just at that point in time stick to your guns and your technique for trading futures, or are you always at point in time looking to see if there's some kind of a hedge or protection that you want to put in the Nadex market?
I always leave my, and I don't mean to use this word, but options open all the time. There are times where, I will sit there and just short the futures or buy the futures just because the trend looks very, very, very strong. And of course, I'm always trying to maximize my gain. However, I always want to minimize loss. And
Sure.
but there are times when I'm a little, I mean, everybody kind of questions their analysis at some point in time. Just, I mean, there's not a person out there that doesn't. I mean, even in everyday life we do that. So I
Right.
will sometimes look at a market and go, I really think this market's going to die off. I just don't see how it's got to go up. And instead of me trying to put a lot of money at risk doing it, a lot of times I'll go over to Nadex and I'll go out and sell, a binary, or I'll sell a bull spread and say, betcha you don't go up. And if you're right, cool. And if you're wrong, you didn't risk that much to see, because to me, you never know where something's going to go unless you buy it. Just flat out. I mean, you got to put your finger in the market to see how it's going to go. I mean, you can always be on the sidelines. I mean, it's kind of like going to a football game. If you really don't care about the two teams, you're not going to pay that much attention to the game. But if your son or daughter's playing in whatever game is in front of you, you're going to be paying a lot of attention to it. And it's the same thing. You got to have something in the market to figure out what it's doing. And so at times, I'm just a little leery about putting a lot at risk in the market, though I still think it's going to be moving in the same direction. I think Nadex is a great way of doing that, but it is a great way of hedging. If I want to kind of protect something, it's a cheap way of kind of protecting something, instead of me having to, go out and buy a gold contract for August and go out there and sell the December contract. So now I have a calendar spread on the thing. I'm virtually flat, but the short term, if it goes down, I'll get paid a whole lot more than the longer term contract. To me, I mean, it's margin wise, it's kind of cheap, but to me, that's just complicated as all get out. Why have to worry about both those contracts when I just come over here and see how it does throughout the day, or even the weeklies? You can look at it, for the week.
Sure. No, that's
hold on one second. 1 second here. Barry asked a question: is pricing based upon traders, or does Nadex set the bid and ask? Yes. Initially, you're going to see things set, but the traders actually do it. And really, it's an odds game, Barry. If you have a 50-50 chance whether this thing's going to be, I mean, we're looking at non-farm payrolls here, above 310,000. To me, they're telling you you got a 50-50 chance there. But for us to be below 290,000, there are a lot of people thinking that ain't going to happen. Look at this. This is 87 by 97. If they're wrong, okay, that means you can sell that, and you can risk $3 for selling it, right? And if it finishes, I mean, if they come in at below 290,000, you'll pick up the $87 to $97. Otherwise, you're only going to risk $3 to sell it. Now, tell me, that's really low risk to high reward. And we've been surprised several times on jobless claims or non-farm payrolls, or I guess this is jobless claims. Sorry. And here, I'm doing it again on this screen. My point is, if we're below this 290,000, you can pick up this 87 to 97 bucks. You risk, let's just say you risk 10 bucks. You sell it at 90. So you risk 10 bucks to see if you're right. To me, that's very, very low risk. I'll be willing to pay somebody 10 bucks to say, hey, this is going to be below 290. Now, I haven't followed the trends or sends up. But if you really watch the jobless claims numbers very closely and listen to all the people who are coming out there saying, we're going to have this many claims, or that many claims, or this many claims, or that many claims, then you might be willing to say, I think, jobless claims are going to drop, which would be very bullish for the market, right? Just because we have less claims being claimed, I guess. But that's the thing. Do we go below there or not? But look at this. There's not a whole lot of distance between 290 and 310. I mean, you're only 20,000 claims here. So, and that's where the current thought is it's going to come out somewhere around 310 jobless claims, or 310,000 jobless claims. Well, if it's below 290, say 289, you're going to get that whole 80 or 90 bucks. But to me, instead of you sitting over here and going, well, I'm going to short the SPY before that comes out, so on Wednesday night you short it, and you're wrong, you can lose a whole lot more money shorting the stock than you could, risking $3 or 10 bucks or whatever it is in Nadex. So there it is.
No, that's an excellent example, and it brings me to one final question that I've got, Jeff, and that is that when you're setting up and you're looking at a trading opportunity, how much do the probabilities in Nadex impact your decision as to where to enter?
I don't. Well, I guess I was just going to say I don't worry a whole lot about the quote-unquote probabilities in Nadex. Price always means a lot. Because if I'm thinking like everybody else is, then I'm not going to be able to make very much on it, right? So what I
Right.
mean by that is, let's go to the indices here, the US 500. Let's just go by 3 p.m. close here. Here we are trading at the 68 area on the S&P. If I think we're going to be above 71, a lot of people don't think that's going to happen. I mean, what are the odds of you getting there? But I tell you, if we get up to 70, you'll see that thing jump up pretty quickly. And all this is telling you, but here's another thing. If I sit there and go, well, I definitely think we're going to settle above 66 today. Well, I can't make anything on that. So I'll leave this alone. I mean, everybody else thinks the same thing, and I can't make anything on it. But to get above this 71.5 area, pretty low odds, which that would be above the high of the June contract. We're trading September now. So the high of the June contract was at 70. So you're arguing that we'll take out everything today, which is fine with me. I mean, you have to only risk $10 here to see if you're right. So, but to me, you'd probably be losing the $10. So
Good point. So I guess in a perfect world, what you'd like to find is that you've got all your indicators telling you that the market is going to break through 70, for example. At that point in time, you're in at a very low probability trade with a high yield, and I guess that's the sweet spot. Doesn't happen all that often, but it sounds to me like probabilities do play somewhat of a role. To your point, if you go with the herd, you're looking at that going, why would I risking $90 to make 10?
Yeah, exactly.
All right, folks. Well, we're coming to the close of the presentation.